I'm going to give you a brief three-part synopsis covering where we are with precious metals, spot prices, especially falling to the downside this summer, what's going on with bullion supplies and price premiums, as well as a historic trade idea you may want to consider as we move closer to the end of this decade and into the 2020s.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hello and welcome to this week's SD Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. This week's update is going to be a little bit different than the normal format. Unfortunately, the guest we were going to have, he was unable to attend last minute, so I'm going to give you a brief three-part synopsis covering, first, where we are. Gold and silver, platinum, palladium, all spot prices in precious metals have been getting pounded lately. Mostly, it's been attributed to the US dollar's recent increase in value versus other major fiat currencies, and of course minor fiat currencies like the Turkish lira, for instance. Now, there's all types of people out there saying, there's perhaps the yuan trade is on, or the SDR, and there's plenty of people who are going to argue this. No one's going to be able to probably pin down exactly what's going on, but you can definitely point to the US dollar strengthening in the last 6 months, and we're going to go through a few charts. For those simply listening to this podcast, I'm going to show charts on the YouTube channel and some various illustrations. I'll do my best to describe them so you get the gist. First up is a US dollar index chart over the past 6 months. Basically, the US dollar's purchasing power versus other major fiat currencies has steadily increased since middle April of this year. Side note, whenever you hear the term US dollar strength, always ask yourself over what time frame, because over the last century, the US dollar loses value by design. Probably over 97% of its value has been lost since the Federal Reserve has been enacted. Now, as you likely know, gold's US dollar spot price action over this same time frame has been down. The chart you can see below, we went from 1350 roughly down to almost 1150. Interestingly, it was not until about middle June when precious metal spot prices really began falling hard. And that's the same story in silver. See the chart here, platinum, and palladium too. On a quick aside, ever since the NYMEX and COMEX has been trading platinum and gold futures contracts respectively, platinum's never been cheaper versus gold. You can see it today on this chart. But that's another topic for another day. Basically, from my experience, reading the comments on SilverDoctors and here on YouTube and just the general sentiment that's out there in the bullion industry, there's basically two camps of bullion buyers out there. Maybe three. One is brand new, doesn't really know anything about it. There have been a lot of brand new buyers this week, and that's a good thing. The other camp's pretty tired. They're kind of sick of the downward price grind since the 2011 highs, and they're pretty much looking forward to dumping their bullion as soon as they can and reach a break-even point, perhaps. The other camp sees it as a long-term insurance play and perhaps even a value play, where you always have some position in bullion. They perhaps are buying it when it's cheapest, and they're selling it when prices go eventually higher, maybe a little bit here and there. Some people just think they're going to hold it the rest of their life and hand it off to their heirs. I'm not really sure what camp. I guess I'm a mix of both those two camps. It would be nice as the prices start rising to sell it off and start buying into other asset classes if they've gone down from their valuations as they are today. But I'd like to hear from you which camp you're in. In the comments below in the YouTube channel, let me know. Which camp are you in? Are you someone looking to sell as soon as you can break even? Or are you looking to hold on and you think that the prices and values are going to go much higher in the future? My bet is you may be a mix of both too. What else is going on? This week, as we saw silver spot prices revisit their late 2015 lows in the middle $14 an ounce range, SD Bullion had its largest one day of customer bullion buying ever. The mainstream and even alternative media rumors of vanishing bullion buyers are somewhat exaggerated. Most of these claims are made by people who only look at brand new US Mint coin sales charts. They have little to no insight into secondary bullion product sales volumes, which can often month on month be more than half the sales volumes. Again, these are not reported in the public domain, and so what you read on Bloomberg, for instance, when they tell you that gold coin sales are at the lowest level they've been since 2007, that's half the story. Occasionally, I write content which gets posted on SD Bullion's new website. This past July, I wrote an article there entitled Silver Gold Price Drops 2018 to 2008 ? In the article, which I'll link in the show notes below, I describe what life was like in the bullion industry in the fall of 2008. Explicitly, I describe what the downward price action did to the retail and wholesale physical bullion markets. And you can find old charts showing how high product price premiums got to back then. You can also find wayback links to show you bullion dealer websites that virtually had no products to sell. From early spring 2008 to late fall of 2008, we went from $1,000 to $700 an ounce gold, and $21 to just under $9 ounce silver. Obviously, we know what happened from there. We went from $9 an ounce silver up to $50, $700 an ounce gold up to $1,900. And that happened within a matter of, roughly 2.5 to 3 years. Could we be seeing the same thing going on right now? I don't know. Neither do you. Possibly there's a combination of lower precious metal prices that will be needed for longer, as well as some sort of crisis in one or two major asset classes to begin seeing bullion products vanish and price premiums gap out, similar to what we saw back then. Next week, we plan on delving into more insights into the physical bullion market's current premiums and supply-demand dynamics with Roy Friedman, a longtime US Mint AP wholesaler trader. We've had him on before, I believe in October of 2017, so definitely looking forward to hearing what's going on with him today. I expect we'll likely glean some further insights into what's happening in the retail and wholesale physical bullion markets, as well if and or potentially when we may begin to see product price premiums gap up and possible shortages. Who knows? A potential trade. We're about to talk about a common sense trade you can consider, especially if you reside in the USA, where you pretty much have to drive an automobile to get around. Now, if you've been paying attention over the last year or so, you've likely seen various versions of this current S&P 500 stocks versus commodity index chart. Basically, the chart screams, buy commodities at the moment. They're cheap. It said the same thing in the early 1970s, before the 1987 crash, in 1999, and now. The chart doesn't go back to 1929, but as you likely know, near the end of manias and market bubbles, there are often other anecdotal signs if you look hard enough. For instance, the following was written in the book, An Empire of Wealth, page 314. You'll likely notice some similarities to today. By the summer of 1929, Wall Street and its millions of customers were deeply out of touch with the underlying economy. Visions of riches danced in their heads. Brokers' boardrooms were full of people watching prices, and even normally sensible and knowledgeable people were caught up in the frenzy. The Saturday Evening Post printed a poem that summer that caught the mood of the country. Oh, hush thee, my babe. Granny's bought some more shares. Daddy's gone out to play with bulls and the bears. Mother's buying on tips, and she simply can't lose. And baby shall have some expensive new shoes. For those simply listening, I am now showing another iconic image from late October 1929. The picture shows a man dressed in a nice slick suit and top hat. His name is Walter Thornton. He stands next to a now highly collectible Chrysler Imperial Roadster, a late 1920s two-door convertible model. Now, you car buffs out there, you might be able to tell me the exact year and version, but it appears to me to be a 1928 or 1929 model, which conservatively retailed for just $1,600 back when it was sold in the late 1920s. Walter's homemade sign sits on the car, now surrounded by onlookers. It reads in bold black letters, $100 will buy this car, must have cash, lost all in the stock market. Now think about this. This guy likely bought this car, new, for over 70 ounces of gold back then. And there he is only months later, looking to sell it for about 5 ounces of gold value, pre-confiscation. I'm not saying something that dramatic is going to happen in the years to come, but similar scenarios are taking shape. Here's the US car loan market today. Over 1.1 trillion US dollars in car loans, an all-time record. We're now almost 50% above where we were in the 2006-2007 housing bubble era. Here's the trade I'm describing. In early May of 2011, a colleague of mine decided to convert some silver profits into a gently used car. Guy bought a mint Toyota 4Runner with only 33,000 miles on it for just over 17 grand. Back in early May of 2011, silver was trading around $43 an ounce. The 400 ounces of silver he used to buy the SUV, he had acquired only a few years prior for well under $10,000. That guy is still driving the same fully paid for car today, no issues. What I'm suggesting is that you save some bullion diligently right now, for when the next bubbles burst, there should be more assets like gently used cars, which will be on fire sale again. Let the mopes continue to take on consumer debts. Once these debts start going bad, and potential financial spillovers ensue, you will likely be able to go buy their assets from them at huge discounts. Save hard, and start preparing your shopping lists. That's all for this week. Thanks for tuning in. Next week, we will likely have Roy Friedman on to discuss the physical bullion market dynamics as he sees them then. If you're watching on YouTube, I will leave 2 follow-up videos for you to check out. One is an evergreen video on silver bullion investing in 2018. The other is a new video I saw today on another channel, which is, in the first 5 minutes, covers some important points in an article I wrote about on SD Bullion this past July 2018. The video covers how worldwide record debt levels have now passed the $250 trillion mark, or quarter quadrillion dollar level. Now, these are hard debt figures, and of course they're hard to wrap your mind around because they're so large. And these are not merely, they're not even shadow bank derivative bets. These are hard debt numbers, and they're very large in size and scope. The first 5 minutes of the video are full of verifiable facts, which we should all be cognizant of, especially as the US dollar strengthens against some recently borrowed $14 trillion in US dollar denominated emerging market debts. This is a reason why Turkey's having trouble, and Argentina, Brazil probably soon. But be warned about the video. The last 5 minutes, in my opinion, are somewhat fear pornish, so take it with a grain of salt. As for this week's Metals and Markets wrap, be sure to like, subscribe, and share it if you got something from it. Thanks for tuning in.